BlackRock, the $10 trillion colossus reshaping global finance. If you follow the financial world, one name towers above all others: BlackRock. With a staggering $10 trillion in assets under management, it is not merely a participant in the investment game. It is the undisputed architect of modern capital markets. Its influence stretches from Wall Street to Main Street, from corporate boardrooms to government treasuries, making it a pivotal force in the global economy. This is the story of how a company founded on a simple, powerful idea mastering risk through technology grew to become an institution that manages more wealth than the GDP of every nation except the United States and China. The Genesis, a lesson forged in loss. BlackRock's origin story is inextricably linked to the career-defining mistake of its founder, Lawrence "Larry" Fink. In the early 1980s, a young, talented Fink was a star in the mortgage-backed securities division at First Boston. He had built the division's business to generate enormous profits. However, a significant misjudgment on interest rate movements led to a loss of nearly $100 million for the firm. This painful experience became the crucible for BlackRock's founding philosophy. Fink realized that financial genius alone was insufficient. Without a systematic, technology-driven understanding of risk, even the smartest bets could be catastrophic. He left First Boston with a mission: to build an investment firm where risk management was not a back-office function, but the core of its identity. In 1988, with a $5 million seed investment from the private equity firm Blackstone Group, Fink and 7 co-founders, including Robert Scapito and Susan Wagner, launched BlackRock Financial Management. The name itself was chosen to project strength, stability, and integrity qualities Fink believed were absent in the risk-obscure markets of the time. The engine of growth, Aladdin and the cult of technology. BlackRock's early focus was on fixed income assets, where Fink's expertise lay. However, its true breakthrough came from a product it initially built for itself: Aladdin, Asset, Liability, Debt and Derivative Investment Network. Conceived by co-founder Susan Wagner, Aladdin was revolutionary. It was a unified software platform that could aggregate a portfolio's holding stocks, bonds, derivatives, etc., and analyze their interwoven risks in real time. For the first time, investors could see a holistic picture of how market shocks, interest rate changes, or credit events might impact their entire portfolio. What began as an internal tool became BlackRock's most potent offering. By licensing Aladdin to other institutions, banks, and pension funds, BlackRock embedded itself into the very infrastructure of global finance. Today, Aladdin oversees over $21 trillion in assets, more than twice BlackRock's own managed funds, making it the central nervous system for a vast swath of the world's wealth. The quantum leap, the iShares acquisition, and ETF dominance. While BlackRock grew steadily, its transformation into a behemoth occurred almost overnight in 2009. In the wake of the 2008 financial crisis, UK banking giant Barclays was forced to sell assets. BlackRock seized the moment, acquiring Barclays Global Investors (BGI) for $13.5 billion. This deal was a masterstroke. It came with BGI's crown jewel, iShares, the world's leading platform for exchange-traded funds, ETFs. ETFs are low-cost, tradable baskets of securities that track indices or themes. The iShares acquisition instantly made BlackRock the global leader in the fastest-growing segment of investment management. This aligned perfectly with broader market trends post-crisis, a shift toward passive, transparent, and low-cost investing. BlackRock's stewardship turbocharged the ETF revolution. It now offers hundreds of iShares ETFs, providing access to every corner of the market. This passive investment arm, built on scale and efficiency, generates massive, predictable fee streams that fuel the entire company. Through iShares, BlackRock became the default choice for millions of retail investors, financial advisors, and institutions, granting it unprecedented scale and market influence. The 2008 crisis, from manager to advisor. The 2008 global financial meltdown was BlackRock's moment of validation. As markets crumbled and legendary institutions fell, BlackRock's obsessive focus on risk analytics made it a rare port of calm. Governments and central banks, including the U.S. Federal Reserve and Treasury, turned to BlackRock as a key advisor. The firm was hired to manage and untangle the toxic mortgage assets that had triggered the crisis. This role elevated BlackRock from a powerful asset manager to a de facto advisor to the financial system itself. It proved that Aladdin and its risk philosophy were not just marketing tools but essential systems for stability. The crisis cemented BlackRock's reputation as the go-to expert during times of systemic distress, a role it has reprised during the COVID-19 market panic and other upheavals. The modern Leviathan: influence, scrutiny, and the ESG frontier. With $10 trillion in assets, BlackRock's influence is omnipresent. It is the largest shareholder in most major publicly traded companies worldwide, from Apple to ExxonMobil. This gives CEO Larry Fink a powerful megaphone. His annual letter to CEOs is one of the most closely read documents in corporate boardrooms, setting the agenda on issues like climate change, social responsibility, and corporate governance, ESG. Under Fink's direction, BlackRock has pushed companies to disclose climate risks, diversify their boards, and consider their long-term societal impact. This has made BlackRock a central and often controversial player in the stakeholder capitalism debate. Critics from the left argue its ESG efforts are not forceful enough, while critics from the right accuse it of pushing a political agenda that diverts from pure financial returns. BlackRock walks a tightrope, using its shareholder votes and engagement to pressure companies while maintaining its commitment to client choice, offering both ESG-focused and traditional investment products. The future: navigating a world of challenges. BlackRock's path forward is fraught with both opportunity and immense challenge. Its size attracts regulatory scrutiny on both sides of the Atlantic, with concerns about market concentration and its outsized voting power. Geopolitical tensions, inflation, and technological disruption pose constant risks to the markets it dominates. Yet, the firm continues to evolve. It is investing heavily in quantitative investing, artificial intelligence, and fintech, including a strategic partnership with Microsoft to transform Aladdin onto the cloud. It is also expanding its reach in private markets and direct lending. The core mission, however, remains unchanged, leveraging technology and analytics to provide clarity, choice, and sustainable long-term returns for its clients. Conclusion: more than just money. BlackRock's journey from an 8-person startup to a $10 trillion guardian of global capital is a testament to the power of a single well-executed idea. Larry Fink's response to his early failure was to build a fortress of data and analysis in a world of uncertainty. That fortress now houses a significant portion of the world's invested wealth, from everyday retirement savings to sovereign nation funds. BlackRock is more than an asset manager. It is a systemically important institution, a technology company, a risk consultant, and a corporate influencer. Its story is a defining narrative of modern finance, one where technology, scale, and an unwavering focus on managing the unknown have created a colossus whose every move shapes the economic future for us all. As it navigates the pressing issues of climate, inequality, and digital transformation, BlackRock's greatest test will be balancing its fiduciary duty to clients with its growing role as a steward of the broader financial system.